Imagine this. You wake up on a Wednesday morning. It is the second Wednesday of the month. You know what that means. Your Social Security payment should be in your bank account. You grab your phone. You open your banking app. You scroll down to check your balance. And something is wrong. Your payment is not there. You refresh the screen. You close the app. You open it again. Still nothing. Your heart starts to beat a little faster. You think maybe there is a delay. Maybe the bank is having a problem. Maybe it will show up later today. But it does not show up later today. It does not show up the next day either. Then, 3 days later, you walk to your mailbox. And inside that mailbox is a letter from the Social Security Administration. You open it. And the letter says you have been overpaid. It says you owe the government thousands of dollars. And it says they are going to start taking money directly out of your future Social Security checks until that debt is paid off. At debt. You sit down at your kitchen table. Your hands are shaking. You read the letter again, and you have no idea what you did wrong. This is not a made-up nightmare. This is happening right now, to real people, to millions of seniors across this country. And today, I am going to explain exactly why it happens, exactly what mistake causes it, and exactly what you need to do to make sure it never happens to you. My name is Artur. I am a Senior Policy Analyst and Retirement Finance Expert. And this channel, Senior Pension Benefits Hub, exists for one reason: to help you understand the rules that protect your money, your benefits, and your retirement security. Now I need you to do something for me. Stay with me until the very end of this video. I know it is a little longer than what you might usually watch, but there is a hidden mistake buried inside the Social Security rules that almost nobody talks about, and if you do not know about it, it could cost you months of payments. I will reveal that mistake near the end. So, please, stay with me. This one matters. Let me start by telling you about a man named Robert. Robert is 64 years old. He lives in a small town in Ohio. He worked as an electrician for 38 years. Good, honest work. He paid into Social Security with every single paycheck for his entire career. 2 years ago, Robert decided to start collecting his Social Security benefits early. He was 62. He was tired. His knees hurt. His back hurt. He had earned the right to slow down, so he applied. He got approved. And every month, like clockwork, a payment of $1,420 landed in his bank account. Life was simple. Life was good. But then something changed. Robert's neighbor owned a small hardware store. And one day, that neighbor asked Robert if he could help out a few days a week. Nothing major. Just stocking shelves, helping customers, maybe 20 hours a week. The pay was $15 an hour. Robert thought about it. A little extra money would be nice. He could fix up his truck, maybe take his grandkids out to dinner more often. So he said yes. Robert started working at the hardware store in January. He worked there all year long, 20 hours a week. $15 an hour. By the end of that year, Robert had earned about $15,600 from that part-time job. Now, here is what Robert did not know. Robert was under his full retirement age. He was 64. His full retirement age was 67. That means the Social Security Administration has a rule that applies to him. It is called the Retirement Earnings Test. And this rule says that if you are under your full retirement age and you earn more than a specific amount of money from work, Social Security will reduce your benefits. In 2026, that limit is $24,480. Now, Robert only earned $15,600, so he was actually under the limit that year. He was fine. But here is where the trouble started. The next year, the hardware store owner gave Robert more hours. Robert started working 30 hours a week instead of 20, and his pay went up to $17 an hour. By the end of that year, Robert had earned about $26,500. That is more than $2,000 over the annual earnings limit, and Robert never reported it. He did not call Social Security. He did not go online. He did not visit his local Social Security office. He did not fill out any forms. He just kept cashing his Social Security checks every month like nothing had changed. Why? Because Robert believed something that millions of seniors believe. He believed the IRS would handle it. Robert figured that since his employer was reporting his wages to the IRS, and since the IRS and the Social Security Administration are both part of the federal government, the information would automatically flow from one agency to the other. He figured Social Security would see his earnings and adjust his benefits on their own. And in a way, he was partially right. The Social Security Administration does review earnings records once a year. They do eventually find out how much you earned. But here's the problem. That review happens after the fact. It happens months after the tax year ends. Sometimes it does not happen until well into the following year. And by the time Social Security caught up with Robert's earnings, they had already paid him 12 full months of benefits that he was not entitled to receive at that amount. The math was simple. Robert earned about $2,000 more than the limit. Under the retirement earnings test, Social Security deducts $1 for every $2 you earn above the limit. That meant Social Security had overpaid Robert by roughly $1,000 over the course of that year. $1,000. And then that letter arrived. The overpayment notice. It told Robert he owed the money back. It told him he had 30 days to repay. And it told him that if he did not repay, Social Security would start withholding 50% of his monthly benefit check until the debt was cleared. 50%. That means instead of getting his full monthly check, Robert would only get half. For months. And Robert was devastated. Not because of the amount. $1,000 is a lot of money, but it was manageable. What devastated Robert was that he had no idea this rule existed. Nobody told him. Nobody warned him. He did what he thought was right. He went back to work to support himself, and the system punished him for it. Now let me be very clear about something. This was not Robert's fault because he is a bad person. Robert is a good man. He worked hard his whole life. He just did not know the rules. And that is the real problem. The rules are complicated. They are confusing. And the Social Security Administration expects you, the beneficiary, to know them and follow them on your own. Let me read you something directly from the Social Security Administration's own website. This is a direct quote. It says, quote, "Reporting your work and wages to Social Security is your responsibility." End quote. Your responsibility, not your employer's, not the IRS, not your accountant, not your financial advisor, not your children, not your spouse, yours. And that is the reporting mistake that is costing millions of seniors their benefits. They do not report. They do not report their earnings. They do not report changes in their living situation. They do not report changes in their income. They do not report changes in their marital status. They do not report that they moved. They do not report that someone moved into their home. They do not report that they left the country for more than 30 days. They do not report that they started receiving a pension from a former employer. And when you do not report, overpayments happen. And when overpayments happen, the government comes to collect. Now let me explain the full scope of what you are required to report, because this is where most people get tripped up. According to the Social Security Administration, if you receive any form of Social Security benefits, whether that is retirement, disability, survivor benefits, family benefits, or supplemental security income, you must report changes to your situation promptly. The deadline is no later than the 10th day of the month after the change happened. So let's say you get married in January. You need to tell Social Security by February 10th. Let's say you start a new part-time job in March. You need to tell Social Security by April 10th. Let's say your adult child moves into your house in June. You need to tell Social Security by July 10th. And the list of reportable changes is longer than most people realize. You must report if you start or stop working. You must report if your income goes up or goes down. You must report if you move to a new address. You must report if your mailing address changes. You must report if you get married or get divorced. You must report if someone in your household dies. You must report if someone moves into or out of your home. You must report if you are admitted to a hospital, a nursing home, or a correctional facility. You must report if you are discharged from one. You must report if your bank account changes. You must report if the value of things you own changes significantly. You must report if you leave the United States for 30 or more consecutive days. You must report if you start receiving a pension workers' compensation, or another government benefit. You must report if your citizenship or immigration status changes. And the Social Security Administration says this, and I am quoting directly from their website again. Quote, "If you're not sure if the change is something that's important for our records, let us know anyway." End quote. In other words, when in doubt, report it. Now let me talk about the numbers for a moment because I think you need to understand just how big this problem is. The Social Security Administration's own Office of Inspector General published a report, and that report found that from fiscal years 2015 through 2022, the Social Security Administration made nearly $71.8 billion in improper payments. The vast majority of those were overpayments, $71.8 billion. And as of fiscal year 2023, the Social Security Administration had approximately $23 billion in outstanding overpayment debt sitting on its books. Money the agency says it is owed by beneficiaries. In that same year, just for supplemental security income alone, overpayments totaled an estimated $4.6 billion. That was 8% of all SSI payments made that year. These are not small numbers. This is not a minor bureaucratic hiccup. This is a massive ongoing problem that is affecting millions of American seniors and people with disabilities. And a lot of these overpayments happened for one simple reason. People did not report changes in their lives. Now I want to pause here and talk about something very important. Because if you are sitting there right now and you are thinking, "Oh no, I think I may have been overpaid," or "I just got a letter," or "I am worried this might happen to me," I need you to take a breath. Because you have rights. The Social Security Administration does not just send you a bill and leave you with no options. There are legal protections built into the system, and I am going to walk you through every single one of them right now. The first protection is your right to appeal. If you receive an overpayment notice and you believe you are not actually overpaid, or you believe the amount is wrong, you have the right to challenge it. You do this by filing a form called the SSA 561U2. That is the request for reconsideration form. You must file this appeal within 60 days of receiving the overpayment notice. But here is the critical detail. If you file within 30 days, Social Security will not start collecting any money from you until they make a decision on your appeal. That is a crucial protection. 30 days. File within 30 days, and they cannot touch your checks while they review your case. The second protection is your right to request a waiver. Let's say you agree that you were overpaid. You are not disputing the amount, but you cannot afford to pay it back, and you believe the overpayment was not your fault. In that case, you can file a form called the SSA 632BK. That is the request for waiver of overpayment recovery. To get a waiver, you need to show two things. First, that the overpayment was not caused by your fraud or intentional misrepresentation. And second, that paying the money back would cause you serious financial hardship, or it would be unfair for another specific reason. And here is something very important. There is no time limit for filing a waiver request. You can file a waiver at any time, even years later. That is different from the appeal, which has a 60-day deadline. The waiver has no deadline. The third protection is your right to reduce the repayment rate. Let's say you owe the money and you are willing to pay it back, but the amount they are withholding from your check every month is too much. It is making it impossible for you to pay your rent or buy your groceries or cover your medications. You can file a form called the SSA 634. That is the request for change in overpayment recovery rate. This form lets you ask Social Security to take less money out of your check each month. You explain your financial situation, and they can agree to a lower amount. Now let me tell you about a recent change that matters. As of April 25, 2025, the Social Security Administration set the default withholding rate at 50% of your monthly benefit for retirement, survivor, and disability overpayments. That means if you get an overpayment notice and you do nothing, they will take half your check. For SSI overpayments, the default rate is 10% of the federal benefit rate, but you have 90 days from the date of the notice to appeal, request a waiver, or negotiate a lower repayment rate before the withholding begins. 90 days. That is your window. And I want to tell you something that most people do not realize. Earlier in 2025, from March 27 to April 25, the Social Security Administration briefly enforced a 100% withholding policy. That meant if you got an overpayment notice during that window, they could take your entire check. Every penny, 100%. That policy caused outrage. AARP fought against it. Members of Congress spoke out, and it was rolled back to 50%. But the fact that it happened at all should tell you something. These rules can change, and when they can change fast. That is why you need to stay informed. That is why you need to watch this channel. That is why you need to understand your rights before you need them. Now, there is one more protection I want to mention, and this is the one I told you about at the beginning. This is the hidden mistake that most seniors do not know about. It has to do with penalty deductions. You see, the overpayment is one thing. That is the money Social Security says you owe because they paid you too much. But on top of the overpayment, Social Security can impose additional penalty deductions specifically for failing to report your earnings on time. This is under a federal regulation called 20 CFR Section 404.453, and the penalties escalate. The first time you fail to report your earnings on time, the penalty is equal to 1 full month of your benefit amount. So if your monthly check is $1,400, the penalty is $1,400 on top of what you already owe. The second time you fail to report on time, the penalty is equal to 2 months of your benefit amount. That would be $2,800. And the third time or any time after that, the penalty is equal to 3 months of your benefit amount. That would be $4,200. These penalties are added on top of the regular deductions for excess earnings. They are punishments specifically for not reporting. And here is the hidden mistake. Most seniors do not even know these penalty deductions exist. They think the only consequence of not reporting is having to pay back the overpayment. They have no idea that the government can charge them extra on top of what they already owe, just for being late with a report. This is the mistake that blindsides people. This is the one that turns a manageable problem into a financial crisis. And for SSI recipients, there are even additional penalties. The Social Security Administration can reduce your SSI payment by $25 to $100 every single time you fail to report a change on time. And if the Social Security Administration determines that you knowingly made false or misleading statements, or that you knowingly failed to report important changes, they can impose sanctions. The first sanction is a withholding of payments for 6 months. The second sanction is 12 months. And the third sanction is 24 months, 2 full years with no payments. And it does not stop there. If you no longer receive benefits, the Social Security Administration can garnish your wages. They can seize your federal tax refund. And if you pass away before the debt is fully repaid, the Social Security Administration may seek repayment from anyone who receives benefits based on your Social Security record. That could be your surviving spouse. That could be your children. This is serious. This is real. And this is happening to people every single day. Now, I do not tell you all of this to scare you. I tell you this to prepare you. Because knowledge is the single most powerful tool you have to protect yourself. So let me give you your action plan. 3 steps. Simple, clear, and effective. Step number 1. Report every change in your life to the Social Security Administration immediately. Do not wait. Do not assume someone else will do it for you. Do not assume the IRS will tell Social Security. Do not assume your employer will handle it. Do not assume your pension provider will notify them. You pick up the phone and you call 1-800-772-1213. That is the Social Security Administration's main number. Representatives are available Monday through Friday, 8 a.m. to 7 p.m. If you are deaf or hard of hearing, the TTY number is 1-800-325-0778. Or you go to ssa.gov, sign into your My Social Security account, and submit a report online. If you start a new job, report it. If you stop working, report it. If your income changes, report it. If you move, report it. If you get married, divorced, or widowed, report it. If someone moves into your home or out of your home, report it. If you leave the country for more than 30 days, report it. If you start receiving a new pension or benefit, report it. When in doubt, report it. And remember the deadline. You must report by the 10th day of the month following the month the change occurred. Step number 2. Check your Social Security earnings record at least once a year. Go to ssa.gov, sign into your My Social Security account. Look at your earnings history. Make sure every year is accurate. Make sure the wages listed match what you actually earned. Errors in your earnings record are one of the leading causes of payment mistakes, both overpayments and underpayments. If you spot a discrepancy, report it to Social Security right away. You will need proof of your earnings, like W-2 forms, tax returns, or pay stubs. And there is a time limit for correcting your earnings record. You have 3 years, 3 months, and 15 days after the tax year in question. After that, Social Security will generally not make corrections except in very specific circumstances, so do not wait. Check your record now. Check it every year. Step number 3. If you receive an overpayment notice, do not panic, but do not ignore it. You have rights, you have options, and you have deadlines. If you believe you were not overpaid, file an appeal using Form SSA 561U2 within 60 days. If you file within 30 days, they cannot start collecting while your appeal is pending. If you agree you were overpaid but cannot afford to pay it back, and it was not your fault, file a waiver request using Form SSA 632BK. There is no time limit for this. If you can pay it back but the withholding rate is too high, file a request to lower the rate using Form SSA 634. You have 90 days from the date of the overpayment notice before withholding begins. Use that time wisely, and please, keep copies of everything. Every letter you receive from Social Security, keep it. Every form you submit, keep a copy. Every phone call you make, write down the date, the time, and the name of the person you spoke with. Documentation is your best friend when dealing with any government agency. Now, let me bring this back to Robert for a moment. After Robert got that overpayment notice, he was scared and confused, but he did not give up. He called Social Security. He learned about his right to reduce the repayment rate. He filed Form SSA 634 and explained his financial situation. And Social Security agreed to withhold a smaller amount from his monthly check. It was not easy. It took phone calls and paperwork and patience, but Robert got through it, and he learned his lesson. Now Robert reports everything, every change in his hours, every change in his pay. He marks the 10th of every month on his calendar as a reminder, and he checks his earnings record online every single year. Robert told me something that stuck with me. He said, "I wish someone had told me this before I needed to know it. I wish someone had sat me down and explained these rules in plain English before I made the mistake. That is why I make these videos. That is why this channel exists. So that you know the rules before you need them. So that you are prepared before a problem shows up in your mailbox." Now, before I let you go, I want to be honest with you about something. YouTube is a wonderful tool, but it is not reliable for urgent, time-sensitive updates. YouTube might change its algorithm tomorrow, and you might never see another one of my videos, even if you are subscribed. The notification bell helps, but it is not a guarantee. And if you found this video helpful, please hit that subscribe button right now. Share this video with a friend, a parent, a neighbor, anyone you know who receives Social Security benefits. They need to see this. My name is Artur. This is Senior Pension Benefits Hub, and I will see you in the next video. Stay informed, stay protected, and take care of yourself.